There have been a lot of headlines recently about multifamily investment firms being in serious trouble in 2023, and with the record low cap rates we saw in 2021 and early 2022, and the changes we've seen in the capital markets over the last 18 months, multifamily investors that were aggressively buying over the last 2 to 3 years are starting to see some major negative changes that's starting to lead to distress. But the specific kind of distress that's materializing is also a little bit unusual and isn't a factor of a lot of the things that we would usually see during the worst of a market downturn, and this is a pretty unique situation that could end up leading to some of the biggest buying opportunities we've seen since the great financial crisis. So to help you understand in more detail exactly what's going on in the multifamily market right now, let's talk through the fundamentals that we're seeing in this sector today, what's causing the distress that's materializing in this asset class, and the opportunities that might end up resulting from these changes in 2024 and beyond. So let's step back and start with the fundamentals here, since these are actually performing relatively well in most markets across the country right now. According to CBRE's Q2 2023 multifamily figures report, the multifamily sector saw positive net absorption in the second quarter of the year of 70,200 units, which was a significant increase over Q1 net absorption figures, which came in at just 1,000 units, and a massive change from the negative net absorption figures we saw throughout the final 3 quarters of 2022. And this positive net absorption trend is all in the midst of record high deliveries hitting the market over the last year, with over 350,000 units having been completed over the last 12 months. And according to Berkadia research, absorption is expected to remain positive even next year, with over 650,000 units projected to be delivered. And based on data from the June 2023 Yardi Matrix National Multifamily Report, year-over-year rent growth clocked in at 1.8% since June of 2022, and occupancy rates held steady at 95% nationally for the 4th straight month on record, showing just how steep this increase in demand has been to keep up with supply growth that's also showing up in record numbers right now. A big part of this is a direct result of the gap between the cost to own and the cost to rent residential housing widening substantially in many US markets over the last 3 years, especially after the 38% increase in home values we saw across the entire country as a whole since August of 2020. According to data from Newmark's Q1 2023 US Multifamily Capital Markets report, the total median monthly payment for homeowners in the US was $2,481 in Q1, which was almost $700 more than the total monthly effective rent in this period of $1,782, and the personal savings rate among Americans that could help fund a down payment was far below the long-term average at just 5.1%. Now, all of these data points indicate that things are trending in a very positive direction for multifamily after what was a pretty rough second half of 2022, but while this might be true from an operations standpoint, the massive rise in interest rates we've seen over the last 18 months has created a capital markets environment that's making these improvements much less beneficial than they would have been for investors just 2 or 3 years ago. According to Yardi Matrix, multifamily GSE or government-sponsored enterprise loans that have been issued in 2023 have had a weighted average coupon rate of 6% through June of this year, which is more than double the 2.9% weighted average from 2021. And this increase in rates has also impacted loan proceeds for borrowers, with the average LTV this year coming in at just 58%, down from 69.9% back in 2021. And for floating rate loans, debt is even more expensive today, with coupons often coming in north of 8%, and with multifamily cap rates across the country still averaging just 5.2%, according to Berkadia's most recent mid-year report. It's really hard to make deals pencil right now in the current interest rate environment. And this gap between interest rates and cap rates is really where this distress that we're starting to see right now is ultimately coming from, especially on deals that were financed with floating rate loans by multifamily investors. And to illustrate how this is actually playing out right now in the market, let's walk through a sample 100 unit multifamily property acquisition from back in the first quarter of 2021, located in the suburbs of Dallas, Texas, and see how this deal might be performing today given current operating performance and current interest rates that are likely affecting the deal. According to CBRE cap rate data from the first half of 2021, Class A multifamily suburban properties in the Dallas-Fort Worth metro were trading at cap rates between 3.75% and 4.25% during this time. So let's assume that this property was purchased right at the midpoint at a 4% cap rate at the start of this year. And according to Berkadia research, effective rents in the market in the first quarter of the year clocked in at $1,193. Occupancy in the market came in at 94%. And if we assume the property was operating at a 40% expense ratio during this time, this would result in an annual NOI at acquisition of just over $807,000 and a purchase price at that 4% cap rate of $20.2 million. And if we assume that this deal was financed with a short-term 2-year floating rate loan, which was the case for many multifamily acquisitions during this time, using that average 70% LTV ratio offered by GSEs in this year, according to Yardi Matrix, this results in loan proceeds at acquisition of just over $14.1 million on the deal. Now, commercial real estate loans with a floating interest rate component are generally priced based on the 30-day average SOFR rate plus an interest rate spread over this index. And if we assume a 350 basis point premium over that 30-day SOFR rate using data from April 30th of 2021, this investor would only be looking at an all-in rate of just 3.51% going into the deal. And assuming this loan is full-term interest only, this would result in an annual cash flow after debt service of just over $311,000 going into the acquisition. But now let's fast forward to the second quarter of 2023 and see how this same deal is performing right now given current market conditions, starting with the cap rate range for Class A multifamily suburban properties in the first half of 2023, which has now risen to between 4.5% and 5% of the market. So again, to use the midpoint value here, we'll assume a 4.75% cap rate would be applied to value the deal at this time. And according to Berkadia's most recent market data, rents in the DFW metro were $1,544 in Q2, with occupancy rates sitting at 93.4% in the second quarter of the year. And if we assume that same 40% operating expense ratio, this now results in an NOI of about $1.04 million and a property value today of roughly $21.9 million on the deal. But remember, this property was initially financed with a floating rate loan, and if we check back in on the 30-day average SOFR rate today, as of early August of 2023, this is now up to 5.1%, or an increase of over 500 basis points since the initial acquisition, and again, using that 350 basis point spread on top of this index, the all-in rate for the borrower would now be 8.6% on that same acquisition loan. And this new rate results in annual debt service payments of more than 2.4 times the initial debt service on the loan. And even with an NOI increase at the property of almost 29% over 2021 values, in 2023, this property would now be producing a loss for investors of over $176,000 per year. And while bleeding cash is never a good position to be in, if this investor wants to stop the bleeding and refinance into a fixed rate loan, if again we use the Yardi Matrix average GSE LTV in 2023 of just 58% using that 4.75% market cap rate to value the deal today, this results in loan proceeds of less than $12.7 million, meaning that the borrower would need to come up with almost $1.5 million of additional investor equity just to pay off the initial acquisition loan. And while this is obviously a less than ideal scenario, a lot has been written lately about investors in even more difficult positions, with current debt service coverage ratios also operating at or well below 1.0x, meaning that these investors either can't service their debt today or may not be able to cover their debt service in the future, and also likely won't be able to refinance without raising substantial amounts of capital from their existing investor base. All of this is to say that unless we run into what appears to be a pretty unlikely event that the Fed starts to cut rates aggressively over the next few months, we might start to see a lot more distress throughout the rest of this year, and ultimately a flood of multifamily properties hitting the market at very attractive pricing in 2024. And if you want to learn more about multifamily investment analysis, or you want to build the skills you'll need to land a job at a top multifamily investment or development firm, as always, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on current market conditions, make sure to hit the like button and let me know, and let me know in the comments what you see happening in the multifamily sector throughout the rest of the year. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.